Welcome. Mr. Greenback. Again, here we go. Starting to look at different asset classes within the financial markets. It's at the utmost importance for you to keep an open mind when choosing which asset is best suited for you. That's the key phrase, suited for you. And why I bring this up is I just bring in my own experience. When I first started in this business, this game called trading and investing, over 13 years ago. Like most at that time, I came in with a very narrow, closed mind. And the first thing I thought that I was going to trade and invest were stocks. Why? Because that's 99% of what was on the television. And I had a coach at that time tell me, Anthony, keep an open mind. Ended up finding out that stocks wasn't best suited for me. All I'm getting at is this: what you may think is best for you may not be. And that's all I'm trying to get across to you. So I just want you to take this segment in with an open mind and start realizing that the market's huge. It's not called the stock market, it's called the financial market. Stocks is just one of many assets. Now, stocks are great for certain things, right? We talked in previous lessons about wealth. They're excellent for wealth. But when it comes to income trading, stocks are not as good because of the pattern day trader rule and leverage. We're going to talk about leverage and margin in this lesson. So let's jump into it. And the power of leverage in the difference of trading stocks versus options. Because if you like stocks, if you're into companies and looking at that kind of stuff, then options is going to be your baby. So let's jump into this lesson. Different asset classes and what they're best suited for, and then the power of leverage. The stock market. So stocks are great for wealth management, longer term investing, swing trading. Not ideal for day trading. I didn't say you couldn't day trade them, but I wouldn't. There's something called the pattern day trader rule, which is a compliance rule by the SEC, which puts rules on you with your brokerage. So basically what the pattern day trader rule states is if you're under 25K in your account, you are restricted to only 3 round trip trades a week. So what is a round trip trade? A round trip trade is, okay, I buy Apple and sell it on Monday. Boom, 1. I buy and sell Microsoft on Tuesday. Boom. I buy and sell Yahoo on Wednesday. Boom. I'm done. I'm out. I'm red flagged. I cannot place any more day trades that week. So right there is a reason for you red flags. Now, I know a lot of you are going to say, well, Mr. Green, I have 25,000. Okay, cool. Let's get to the next slide. Stock market, 9:30 a.m. to 4 p.m. So there's a restriction there. It's only open during those hours. Yes, there's pre-market after hours trading, but you get the gist of what I'm saying. Monday through Friday. Normally, stocks are ideal for, like I said, that longer term trading, which could be the big brokerage account, the IRA, even the 401k, the 403b, whatever it is. But it's usually derives for longer term.
Hey folks, Mr. Black here. Just jumping in because we have had some changes that may be affecting the pattern day trader rule pretty significantly. And this was after this was recorded. This was recorded several months ago by Mr. Green. So I just wanted to update some of these changes. So as many of you may know, the pattern day trader rule may be changing very soon, late 2025, early 2026. FINRA has already approved the changes and are now just waiting on SEC approval for these changes. So if these changes do come into effect, it's going to change the requirements for people who want to day trade stocks and options. Instead of requiring the 25,000 in equity, traders will now need to maintain sufficient funds just to cover intraday margin calls. So approximately, it's estimated about 25% of the position's value is what they will need to be able to take the day trade. So this would change things pretty dramatically. The idea is to increase accessibility for retail traders who are currently restricted by that high minimum capital requirement. All right, let's keep going with the lesson. So let's talk a little bit about leverage and how this affects the different asset classes, and how this can affect and give you opportunities as a trader. Now, if you open up the average stock account, despite these changes to the pattern day trader rule, there are still tremendous benefits in using leverage when you use it correctly. It is very important to learn how to use leverage correctly. Of course, sometimes people will over leverage positions and that will get them into trouble. But if you learn how to use leverage correctly, you can actually reduce the amount of capital you trade with, you can reduce your risk exposure, and actually generate higher rates of return. So really, really important to just understand how to do it correctly. So let me give you an example here that will make it mathematically sound. Let's say you have a $2,000 account. You might have more, you might have less, it doesn't matter. We're just using it for this example here. If you open up a typical stock account, stock brokerage account, most of them will provide you with 2-to-1 margin leverage, right? They will allow you to buy up to $4,000 worth of stock with your $2,000 account. They will basically take your $2,000 account and multiply it by 2 and allow you to buy up to $4,000 worth of stock. Now, to be clear, you are fully responsible for that $4,000. So if you buy $4,000 worth of stock with your initial $2,000 investment, that's the part that you contributed. If you lose more than your initial $2,000, you will owe your broker money, right? So that other $2,000 is essentially just a loan. And if you do go into the negative on your side of the initial investment, they will require you to pay that money to them. That's called a margin call. So they may stop your trade. They may even shut down your account if you don't do so in a very timely manner. So even though they are allowing you to buy up to $4,000 worth of stock, you are fully responsible for that $4,000. That $4,000 is essentially just a loan. Now, options is a bit different. Options is a leveraged asset class. In options, you are using leverage. And because of that, because it's a derivative, instead of you buying and selling the shares like you would in the stock market, in the options market, you are buying and selling contracts that give you the right to buy or sell the underlying asset at a specific price until a specific date. But we'll talk about that more in depth when we talk about the different asset classes. The main thing that's important about options is this. Options provides you with a minimum of 10-to-1 leverage. You can actually get way higher than that, but minimum is at least 10-to-1. So what does that mean? That means your $2,000, if you multiply that by 10, is now worth $20,000 of buying and selling power. And that's really significant because it takes money to make money. So if you have more buying and selling power, you are capable of doing more in the market. That's one of the great things about understanding how to use leverage correctly. Now, this is the part that's very interesting. What if you're wrong? What if you screw up every trade, right? And we're just talking about directional trading for anybody who trades options. I'm talking about buying calls and buying puts. We're not talking about selling calls, selling puts yet, because that's a little bit different in terms of obligation. Just directional trading the same way we would if we bought or sold stocks. Here we're talking about buying calls and buying puts. If I were to buy calls and buy puts, if every trade I have moves against me, am I responsible for the other 18,000 of buying and selling power here? And the answer may surprise you. The answer is no. I am only responsible for the value of the contract. I cannot lose more than the value of the contract. Because the reality is, since I'm using a derivative, if my contract is no longer of interest to anybody, that just means the contract expires worthless. Nobody wishes to buy or sell that contract. So this is the difference with options. So you are able to do more. You have more buying and selling power, but you have less risk exposure. And that's, of course, saying if you're trading even without a stop loss, which we would never do. We would always protect our downside on any trade we took. How about futures? Futures provides 20-to-1 leverage. So your 2,000 is now worth 40,000 of buying and selling power. You have a little bit more power in the market. And finally, you have Forex. Forex is the largest market in the world. It's the currency market. The Forex market provides you with 50-to-1 leverage here in the United States. If you go overseas, you can get even higher leverages than that. But that means your $2,000 is worth 100,000 of buying and selling power in the Forex market. But once again, if you're wrong, if every trade you place moves against you, realistically, what's the most you're likely to lose? No more than the value of the standard lot, which is those $2,000. So if you understand how to structure leverage properly and you use it to your advantage, It allows you to reduce the amount of capital you trade with. It allows you to reduce your risk exposure, but because you have more buying and selling power, you are able to generate higher rates of return in comparison to your investment than if you were trading just the straight stock. And that's why if you're looking for income generation, if that's your goal, like I'm trying to generate income regularly, Mr. Black, week to week, month to month, day to day, so on and so forth, you're much better suited to use a leveraged asset class because it allows you to do a lot more with a lot less. All right, let's talk about each of these different asset classes. Now, before I move on to the next slide, one important thing to understand is, do leveraged asset classes move more quickly? Yes. Leveraged asset classes absolutely move more quickly than unleveraged asset classes. So the need for trading properly, right? Proper risk management, proper entries, targets, stop losses, all in place before we even enter the trade, never goes away. Doesn't matter if you're trading stocks, options, futures, Forex, crypto, you still need to trade properly. Let's talk about each one of these in depth though. All right, so let's talk about options first. Now, options is the most versatile of all the asset classes. It can be used for income generation, for wealth management, even for portfolio protection if you understand how to structure it properly. So it's really, really versatile and can be used in many different forms. Options is a derivative based on the value of underlying securities, such as stocks. So it's a bit different what you're doing in options. In options, instead of you actually buying an asset, what you're doing is you're obtaining the right to buy or sell an underlying asset at a specific price called the strike until a specific date. So you're not actually buying the asset, you're buying the right to buy or sell the asset at a specific price until a specific date. Now you have at least a minimum of 10 to 1 leverage, but you can actually get way higher than that depending on the strike and expiration you choose. It is definitely the most versatile of all the asset classes. You can trade it in any market condition, whether the market is bullish, bearish, or consolidating. Even if it's just consolidating, moving sideways, you can still generate returns with options. You can do things like spreads and stuff like that. So really, really versatile, great for many different forms of trading, and really great for income generation as well as long-term positioning. Now, how does options work? A lot of times people have a hard time understanding the concept behind options and what it's doing. So let me give you an actual real-world example that we used here. So this is an actual real example. We took away the name of the ticker because I didn't want people to think when we were sharing it online that this was a trade we were taking. I wanted them to understand the math behind it. So it's not ABC stock. It's just we just use that as a placeholder for the ticker, all right? So let's understand the difference. Let's say if I was buying stocks versus buying a call contract, which is a directional trade if you're going long. So if I wanted to buy 100 shares of ABC stock, and again, this was a real trade we actually did take. At the time when we set up the trade, if I bought the straight shares, each share was trading at $76.23. So if I wanted to buy 100 shares of this stock, it would have cost me $7,600. Or I could use options and I could control 100 shares of ABC. So by buying the call option, instead of me actually buying the shares, what I'm doing is I'm buying the right to buy the shares. In this case, the closest strike price we could get on this asset was $77.50, or at least the closest that made sense in terms of the position. And to have that strike price with the expiration we chose, it cost us $6.22 per share. Because there are 100 shares in there, 100 times 622 is $622. So here's the difference between the left side and the right side. Over here, I bought 100 shares of ABC stock. I own 100 shares of ABC stock. Over here, I have a contract that gives me the right to buy 100 shares of ABC stock at the limit price of $77.50 until this contract expires. And that right, that contract, cost me $622. So that's part one. That's understanding the difference between what you're doing on the left versus the right. Now let's look at this trade, and we'll give an example if it worked in our favor and if it worked against us. In this case, it did work in our favor, but it doesn't really matter for this example. The point of this example is just to show you how this works in terms of trading the stock versus the option. All right, so let's see what happens with this trade, if it moves in our favor or if it moves against us. Now, as I said, we did win this trade, but it really doesn't matter for the purposes of this example. So the same way we buy where banks are buying, when we're targeting levels of exit, we're targeting where the banks are selling, right? Buy where the banks buy, sell where the banks sell. So in this case, when the trade hit our profit target, it was a return of 2,377 on our $7,600 investment. In other words, there was a rate of return of about 31%. And that's fantastic. That's a great trade, right? From a stock trading position, fantastic return. Now, if I take over here on the option side, the exact same move in the market, no difference whatsoever. My gain was actually a little bit less, right? It was 1668 because there was a cost associated with buying that contract. But this is the part that's really of interest. What is my rate of return? Well, my rate of return is 268% because I only invested $622. This is why leverage is such a powerful tool when you use it properly, right? Because realistically, from a trader's perspective, would you rather invest $7,600 to make $2,300 or $622 to make $1,600? It's not rocket science, right? This is vastly superior in terms of rate of return. And more importantly, are you limited to one contract? No, right? What if you went just a little bit more and you traded two contracts instead of one? That's it. Just two contracts instead of one. Well, now you would have invested $1,244, and now you're looking at gains of over $3,300. So now you literally would have invested less to take the position and made more in the market in terms of return. And this is why leverage is such a powerful tool when used correctly. Now, where people get into trouble is sometimes they will say, well, I'm going to take my entire account and I'm just going to buy as many contracts as I can. And now they're kind of defeating one of the big benefits of leverage, which is the ability to reduce your risk exposure. If you're just going to take everything and invest all in, well, now you have just as much risk, but you have it in a more volatile, faster moving market, right? So the point of leverage, if you use it correctly, is you can reduce the amount of capital you trade with and reduce your risk exposure. Now, what if we had that same move, but the trade moves against us? Instead of going up 2,300, it went down 2,300. Well, over here, if it went down 2,300, I lost 2,300. Over here, what happens? Well, here, I can't lose more than the value of the contract because, again, options is a derivative. If it moves more to the point where nobody wants my contract, that just means the contract expires worthless. So my maximum risk exposure over here on the option side is those $622 associated with buying that call contract. And this is, again, why leverage is such a powerful tool. All right, let's keep going and talk about futures for a bit. So futures market is an exchange in which derivative contracts lock in the future delivery of a commodity or security at a set price. Now, this is an excellent market for day trading and income generation. It is primarily associated with commodities, things like gold, oil, silver, soybeans, cattle, etc. If you ever watched that movie Trading Places in the 1980s, what did they trade? Frozen orange juice and pork bellies. It's an old movie with Dan Aykroyd and Eddie Murphy. Either way, in the futures market, it's very associated with commodities. But what's really interesting about futures is it's actually very versatile. You can actually trade other markets through the futures market. You can trade stock indices through the market. So you can trade like the S&P, you can trade the NASDAQ. And those are actually two of the most heavily traded contracts in the futures market, RES and NQ. You can trade Forex through the futures market. So if you're passionate about currency trading and you're like, oh man, I love trading currencies, you can actually trade Forex through futures as well. And you can even trade crypto, which crypto itself is an unregulated market, but you can trade crypto through futures, and now you're actually trading crypto in a regulated market space. So very, very versatile asset class, great for income generation. It is by far the fastest moving of all the markets. So if your passion is day trading being you are in and out of the trade within the same day, this is definitely one of the best and most popular asset classes for day trading because of the speed with which it moves. So very, very popular for day trading. Cool things about it, killer 20-to-1 leverage, so it gives you more buying and selling power. It is virtually a 24-hour day market, 5.5 days a week from Sunday afternoon to Friday afternoon. So it gives you a lot of flexibility of time, very different than stock and options where you're trading from basically 9:30 to 4 during main market hours, right? Here, maybe you wake up a little before you go to work, set up some bracket orders, and go about your day. You don't need to sit there watching those trades if you set up a bracket order, right? Maybe you get home from work, eat some dinner, set up some bracket orders, and go about your evening. So futures gives you a lot more flexibility to fit trading within your schedule. It also offers certain tax advantages. You pay lower taxes in futures and Forex than you do in stock and options. And even though we know that pattern day trader rule may be going away, we will see how that works with the SEC approval. The other cool thing here with futures and Forex is there is no pattern day trader rule. There is no minimum capital required. You can take as many day trades as you want within a week. There are no restrictions in that regard, so you're not handcuffed. So very, very versatile asset class, great for income generation. Can be used for intermediate long-term position trading as well. And certainly some people do incorporate this into your portfolio, myself included. But most people who are trading futures will often be day trading. Also very common for a lot of people to enjoy the use of prop firms. Prop firms, if you are a consistent trader, can establish that consistency. They will actually fund you and give you funds with which to trade, which is very popular amongst a lot of futures traders as well. Okay, so let's keep going here with Forex. Now, Forex is the largest market in the world. It is the foreign exchange market. So that's where Forex comes from. It's mashing up the two words foreign and exchange. And this is primarily known as the currency market. Essentially, what you're trading in the Forex market is the exchange rate between one currency and another currency. So if you've ever traveled to a foreign country, you probably had to exchange your personal currency for whatever currency that country had. And they would give you some exchange rate that they would exchange that currency for the other currency, right? That exchange rate is fluctuating 24 hours a day, 5.5 days a week. So when you're trading the Forex market, what you're doing is you are speculating whether one currency will valorize or devalorize against another currency. You can trade some other things through Forex as well, but that's primarily what it's known for. Now, Forex is by far the largest market in the world. This is where banks, hedge funds, major financial institutions invest the majority of their money. To give you an idea of just how massive the Forex market is, it trades over 8 trillion, that is with a T, trillion dollars per day. So it's a massive, massive market, bigger than all of the other markets of the world put together. So really, really massive market, very versatile. It can be used for both income generation as well as wealth management. It does tend to move better from a swing trading perspective. So if you are trading it for income, a lot of Forex traders will swing trade Forex. Swing trading means you're holding a position overnight rather than getting in and out in the same day like a day trade, rather than day trade it. You can, of course, day trade it as well, but a lot of Forex traders will prefer to swing trade it just based on how Forex moves. Gives you incredible 50-to-1 leverage, so way more buying and selling power here in the US. If you go overseas, you can get even higher leverage than that. I've seen as much as 500-to-1 depending on some countries. Great market for new traders as well because it has the lowest barrier to entry. So Forex is the only market in which it doesn't matter how much capital you have. Regardless of how much capital you have, whether you have, $5 million or $500, those two traders can take the exact same trade in the Forex market. Like same entry, same profit target, same stop loss. The reason being you can adjust the value of a price interest point to whatever you want it to be based on the number of units you're trading. So now, obviously, will the guy with 5 million make more than the guy with 500? Of course. But what's cool about this is what that means is even if you're starting with a very small account, you will be learning the exact same mechanics you will employ as you grow your account over time, right? You're not going to change the way you're trading. You're just going to change the amount of capital you trade with. So an example of this is when I first started trading Forex over, very long time ago, over 20 years ago, I would personally risk $1 to make $3 or more. And this wasn't a lack of capital. Like I had more capital to invest into the market. The reason I started so small, the reason I started with such small amounts of capital was I didn't want to get emotional about my trades. I want to take as much emotion out of my trades as I could. And instead of focusing on the returns, to focus really on the process. Because if I lost a buck, did I really care? Was I stressed about losing $1? It was a buck. I was going to be fine. If I lost a buck, it wasn't going to change my life significantly one way or the other. Conversely, if I had a profit target of $3, was I like, if I hit that target, was I like, oh man, time to quit my job? No, it's $3. It wasn't a significant amount of capital. So it allowed me to take a lot of the emotion out of the trading and really just focus on the process. Like focus on making sure I was trading properly, not over leveraging, not over positioning, making sure I was following my rules, and establish that consistency first. Once I got to a point where I was actually consistent with my trading, where like after wins and after losses, I was consistently hitting my profit targets, that's when I started scaling up my position. And that's what's so cool about Forex, because if you can become a consistent trader risking $1 to make $3, those are the exact same mechanics as trading 100 for 300 or 1,000 for 3,000. The trade itself doesn't change, just how much capital you put on the trade changes. So really, really cool for new traders because it allows them to start very small and work on establishing consistency first before they start getting, tied up in the emotional value of the actual money. It is an extremely liquid market, of course. You're talking about major currencies. So what's cool about Forex is if you open up a trade and you're trading one of the major currencies, it opens instantly. If you close a trade, it closes instantly. Very, very liquid market. Tons of liquidity, tons of active buyers and sellers in the Forex market, especially when you're talking about major currencies. It is a 24-hour day market. So you can trade it 24 hours a day, 5.5 days a week, the same way you can with futures, essentially, right? Except here it's literally 24 hours a day. And it also offers those same tax advantages that you have with futures. You pay lower taxes in futures and Forex than you do in stock and options. So you gain certain tax advantages. So really great asset class, great for both income generation as well as wealth management, killer leverage, excellent for new traders, giving that lower barrier to entry, and also very versatile with that ability to be able to trade anytime, day or night. Finally, we have crypto, the unwanted stepchild of the financial markets, right? Now, crypto is an interesting market because of all these markets that we've looked at, stocks, options, futures, and Forex, crypto in the United States, at least, is the only one that is unregulated. It is still an unregulated market. So cryptocurrency is a digital currency that is protected via cryptography, and it is distributed over a decentralized network of computers. That's the concept behind the crypto market space. Because it is an unregulated market, there is a lot more volatility. There's a lot more, of course, risk, right? And there's a lot more manipulation. So you have to be a little bit more careful in the crypto market space, especially if you're trading illiquid assets. So if you're looking at a lot of meme coins and things of that nature, you're going to see a lot more manipulation in this market because it is currently unregulated. There aren't regulations about that sort of stuff as of yet. So it is better suited towards income generation. I understand that a lot of people treat this as a wealth management concept, and there is some risk associated with that, as there is with any trade. But most professional traders use this more as a secondary market. We do trade crypto here at TradePhantoms, so I'm not saying we don't trade it, but we do focus on the major cryptos, the ones where major banks and institutions are buying and selling, because those we're capable of generating more consistent returns with. And I do encourage people to, of course, take profits regularly, always manage your risk, never over leverage, never position, so on and so forth, right? It is traded 24 hours a day, 7 days a week. So this is the only market that's open every single day. So I think it's here to stay. I do think we will see changes in the crypto market space over the next few years. I think most countries in the world are going to be coming out with their own digital currencies. And I think that's going to change this market space and probably eliminate a lot of these altcoins and things of that nature. Altcoins, alt tokens. But I don't think crypto is going anywhere. And this is, a lot of people think this is the future of the financial markets, and it could very well be, or it could be incorporated into the financial markets as just another asset class. But it's definitely here to stay, and it's definitely something that's worth learning about. That is it for lesson 9. We hope you enjoyed this lesson. In lesson 10, we're going to be talking about institutional order flow. So we're going to be talking about balance and imbalance in order flow and price action analysis, and how to understand institutional order flow and supply and demand formations. So that's coming up next. We hope you enjoyed this lesson. That is it for today. This is Mr. Black signing off.